Welcome to Taking Stock. I'm Amanda Lang. Coming up on the show, the Governor of the Bank of Canada on this week's decision on interest rates and the path for the Canadian economy from the bank's point of view, plus measuring the economy in real time. A new tool offers a grim outlook. That's all ahead. First, for the week that was in business, it's time for the briefs. The Bank of Canada lowered rates by a quarter percentage point this week, as was widely expected. Now sitting at 2.5%, the bank said while it's mindful of the path of trade talks and the cost of tariffs, the recent weakness in the economy, especially jobs, prompted the move. It also noted that shifting to new trade partners brings with it higher costs. Inflation in Canada rose 1.9% in August, slightly above levels in July, but below expectations. The annual rate has been affected by the cancellation of the carbon tax, which lowered the cost of fuel. Excluding gasoline, inflation slowed to 2.4% in August, below the previous 2.5%. While prices remain firm, they are not accelerating. The U.S. central bank lowered rates this week following weaker jobs data and a slowdown in parts of that economy. The Federal Reserve also flagged inflation that remains elevated, but the central bank is expected to lower twice more this year. The federal government is allotting $13 billion to build thousands of affordable homes across 6 cities. Build Canada Homes is the newly created federal housing agency that will oversee projects, including 4,000 factory-built homes on federal land, with capacity to increase the number of units to 45,000. $1 billion will be spent on transitional and supportive housing. A data breach at Canada's investment industry regulator potentially exposed everyone from financial advisors to executives to traders. The Canadian Investment Regulatory Organization sent out notices to registered clients, alerting them that their personal data might have been breached on August 11th. Information access could include names, addresses, email addresses, birth dates, and place of birth. Home sales were strong in August across the country, according to the Canadian Real Estate Association. The volume of sales hit a 4-year high as 40,257 homes changed hands. Prices were more muted, gaining 1.9% year over year and declining slightly from July. The national data also smooths huge regional differences, with big price increases in Saskatchewan and Quebec and declines in Calgary, Vancouver, and Toronto. And those are your business briefs. With all eyes on the Bank of Canada this week, here's a look at rates and inflation by the numbers. At 2.5%, interest rates in Canada are neither high nor low, depending on how you look at it. Rates hit a high of 5% in 2023 and 2024 as the bank moved to contain high inflation. Back in 2022, prices in Canada rose 6.8%, which was a 40-year high, driven by supply chain shocks related to the pandemic and the war in Ukraine. While inflation cooled slightly by 2023 to 3.9%, the bank kept rates high to make sure prices came down. Then in June 2024, the bank started lowering to 4.75% that month, ending at 3.25% by the end of the year. After hitting 2.75%, the bank held there for several meetings. While inflation was cooling, it was not entirely in the bank's target range of 1% to 3%. Wages in particular were showing inflationary pressure. Fast forward to this week, inflation is still running close to the 3% on some closely watched measures, while there are growing signs of potential recession, and you have the makings of a very complex rate call. That complex decision-making was very much in evidence this week as the bank made its call on rates. Tiff Macklem is the governor of the Bank of Canada. I spoke with him on this week's episode of the Wonk podcast. Here's our conversation.
Well, look, uncertainty is still elevated. And, as you understand very well, monetary policy can't undo the effects of tariffs. We can't reverse that. The only thing we can do is try to help the economy adjust to a new trade relationship with our biggest trading partner and make sure we keep inflation well controlled. Canadians are still, they remain concerned about the cost of living, and our job is to worry about that for them, so they don't need to worry about the cost of living, and certainly that's what we're focused on. Coming to the complexity, because it's a very sectoral shock, it's very complicated. The tariffs have been, they've been on again, off again. It's been a little more stable lately. That does mean you've really got to look at this from a risk perspective. And the decision to cut today really reflected the fact that the risks had shifted. The economy is weaker, as you mentioned, while there's some mixed signals. inflation does look a little more contained, and against that background, a cut was appropriate.
You mentioned, of course, and again, this uncertainty of what happens with tariffs, not in your hands. It's still very much an unclear picture of where this goes. So you do have these scenarios of an escalation of the problem and a de-escalation of the problem. So just let's talk about, we don't know likelihood of those two things, but sitting here today and you're looking at the Canadian economy, the question a lot of people want to know is, are we sliding towards recession? We got that contraction in the second quarter. There's a concern about it. What's your feeling about which direction we do go?
Well, as you said, it's going to depend a lot on what happens with tariffs. The simple arithmetic of it is that 25% of our GDP is exports to the United States. We are very integrated with the United States. What happens with U.S. tariffs has a very big impact on our economy. If tariffs stay roughly where they are, that would be the current tariff scenario that we put out in July. We were expecting a sharp contraction in the second quarter. In fact, it came out at negative 1.6. We were monitoring negative 1.5. So it was very much as expected. And we saw a very sharp drop in our exports, down 27%. That partly reflected the fact that businesses in the first quarter pulled a lot of those exports forward to get ahead of the tariffs. So that boosted first quarter GDP. Of course, that unwound sharply in the second quarter, and you saw this big drop. Going forward, if tariffs stay roughly where they are, we are projecting a recession. We're projecting slow growth. Something around 1%. It's not going to feel very good. It's slow growth. And it's slow because the economy needs to adjust to this new reality, this new trading relationship, this new trade friction with the United States. Why is growth not negative? Well, we expect exports we don't expect a lot of growth in exports, but we don't expect a further big decline. We are seeing some consumption growth. You saw a little bit of recovery in housing. So we think that'll be enough to get some modest growth. But as I said, it's not going to feel very good. And then there are other scenarios. If there was a significant escalation of the tariffs, yes, you could see another negative quarter or two. So yes, that would be a recession. Hopefully, if we can de-escalate some of those tariffs, that recovery and growth will be better. These new tariffs, the unpredictability of our relationship with the United States, I think, is underscored for businesses. Is yes, they need to look for new markets. It's been very easy to export to the United States. It's gotten a lot harder. Businesses are now putting more effort in figuring out how to get product to new markets, how to develop those markets. And as you said, that all has some cost.
Coming up, more of my conversation with Bank of Canada Governor Tiff Macklem. Stay with us.